In this topic we're looking at exchange rates, and in particular we're going to focus on exchange rate determination. And the first thing you need to realise is that the exchange rate is a price. It's the price of one currency expressed in terms of another currency. So the rate at which you can actually swap one currency for another. And since the exchange rate is a price, just like any price, it is determined by the forces of demand and supply. It's convenient because most foreign exchange markets are perfectly competitive, so there's really nothing stopping the price from, or the exchange rate from responding to changes in the forces of demand and supply in most situations. The exception to that, of course, is the fixed exchange rate systems. In that situation, central banks will actually manipulate the exchange rate to keep it at a predetermined fixed level. So we need to understand the difference between floating and fixed exchange rates, and it's very important that you understand the advantages of both of those. First of all, how a floating and a fixed exchange rate system operates, and the advantages of either of those. Somewhere in the middle between floating and fixed is managed exchange rate systems, and a good example of that is Singapore. The example of a fixed exchange rate system we'll be using is Hong Kong. After we've gone through that, we'll be looking at the euro and then the idea of optimal currency areas, and asking the question, should the euro have ever existed? So the first thing you need to realise is that most floating exchange rate systems have the exchange rate responding to changes in the demand and supply for the currency in the foreign exchange market. So what I've got here in this diagram is the demand and supply of the Australian dollar in the foreign exchange market. So this is, a lot of people get this diagram confused with a market for money. This is not a market for money. It's not a market for loanable funds. It's actually a market for foreign exchange. So I like to call this diagram the foreign exchange market. Now, one of the main things that is going to drive the value of any exchange rate is relative interest rates. So what I've got here from this starting point, this starting equilibrium, is a situation under this title relative interest rates where interest rates in Australia increase to become higher than interest rates in the rest of the world. Now, if that happens and interest rates in Australia are higher, that's going to attract investment money into Australia's debt markets, and that will shift the demand curve for the Australian dollar to the right, because as this money is flowing into Australia, well, actually to get the money into Australia and earn the higher interest rate that is available in Australia, foreigners will have to actually buy Australian dollars before they can buy Australian debt to actually earn that higher interest, the higher interest rate. So as foreigners are sending their money into Australia and swapping it from yen and euro and US dollars into Australian dollars, at that point it creates a demand for the Australian dollar in the foreign exchange market, and so this demand curve shifts to the right. You need to be able to illustrate these major causes of exchange rate movements and support them using a diagram like this. The second thing that's going to happen is, because interest rates in Australia are now higher, less of the money that was going to flow out of Australia, of the money that flows out of Australia, less actually flows out. So there is a smaller outflow of money, or a reduced outflow of money, and so more domestic funds remain in Australian debt markets because of these higher interest rates. That causes a decrease in the supply of the Australian dollar, because if there is a smaller amount of domestic funds flowing out of Australia because interest rates in Australia are now higher, that reduces the amount of Australian dollars passing through the foreign exchange market, and it is effectively a reduction in the supply of the Australian dollar. So in this diagram we've got the demand curve increasing, the supply curve decreasing. They combine to cause an appreciation of the Australian dollar. So higher interest rates in Australia will mean that the Australian dollar will be appreciating. The next major cause, relative inflation rates. Once again, we've got a situation where there's a higher inflation rate in Australia than the rest of the world. And so that means prices in Australia will be increasing faster than they are in the rest of the world. Now that has two effects, one on the demand curve, one on the supply curve. Because Australian goods are now more expensive relative to goods being supplied in the rest of the world, foreign demand for Australian goods and services will decline, so the demand curve will shift to the left. At the same time, Australians will buy more relatively cheaper foreign goods and services and fewer more relatively expensive Australian goods and services. And that will shift the supply curve for the Australian dollar in this forex market to the right. So with higher inflation in Australia, both foreigners and Australians buy fewer Australian goods and services and more foreign goods and services. The net effect is a depreciation of the Australian dollar. The next major cause, commodity prices. Obviously Australia is a large commodity producer and exporter, and so the commodity price index really does drive the value of the Australian dollar to a large extent. So what we've got here on the left is an index of commodity prices, and you can see from around about 2003 right through to just before the global financial crisis, around 2007, this huge increase in the commodity price index. It went from just below 40 in around about 2003 up to about 115. So that's quite a substantial increase in commodity prices, and you can see that the Australian dollar followed it over that same period. Commodity prices dropped in 2008-2009 as a result of the global financial crisis and concern that there would be a global macroeconomic slowdown. Commodity prices fell, but then people realised that those fears were overblown to some extent. Commodity prices raced back up to over 120, and then the end of the mining boom, commodity prices started to fall again. And you can see that this really has a high degree of correlation with the value of the Australian dollar. So the overall trends are quite similar. So particularly in the short run, it's interest rate differentials and commodity prices which really drive the value of the Australian dollar, as well as investment flows. But of course a lot of the investment flows are being attracted by interest rate differentials. Not all investment flows are being driven by interest differentials. And that would be a third one, just general investment flows tend to drive the value of a country's currency as well. So I haven't got a slide on that, but money flowing into Australia will simply shift the demand curve, or investment flows flowing into Australia will simply shift the demand curve for the Australian dollar to the right. So the next thing we look at is a fixed exchange rate system. So just to summarise the floating exchange rate system before we move on to the fixed system, you really do need to be able to use demand and supply diagrams to explain what drives the value of a floating exchange rate over time. And I've given you 4 there, so inflation differentials, interest rate differentials, commodity prices, which is relevant for countries like Australia, Norway and Canada, which are commodity producers and exporters, and then investment flows as well. Now, as part of your reading, you'll probably discover other causes of fluctuations in floating exchange rates, and so it'll be up to you to be able to model those using demand and supply analysis. So what we go on to now is fixed exchange rates, and I've got an example where I'm assuming that the Australian dollar is fixed against the US dollar, and it is fixed at 1 Australian dollar equals 70 US cents. So we start off at this equilibrium here, the intersection of the original demand curve and the supply curve. And then, just so that we understand how fixed exchange rate systems work, that is in particular how the value is fixed or kept at that 0.7 level by the central bank, or in Hong Kong's case it's a currency board which has the job of keeping the Hong Kong dollar fixed. So just so that you know how it's kept at 0.7, let's assume a large increase in the demand for the Australian dollar. Of course, you need to be able to give examples of the sorts of things that could cause the demand for the Australian dollar to increase. Now you're probably already armed with a handful of them, but try to find other factors which could cause large increases in the value of a currency through an increase in demand. It's just good practice in using the model. So the demand for the Australian dollar increases for whatever reason. Could be commodity prices have increased, it could be a massive amount of money flowing into Australia, capital flowing into Australia. Two things can be done, and this is the way central banks typically control exchange rates when there is upward pressure on an exchange rate. When there's downward pressure, the reverse case is true, and I'll let you figure that one out in your own time. But when there's an increase in the demand and it threatens to push the exchange rate up to 0.75, something needs to be done to prevent that exchange rate moving away from 0.7. So with a big increase in the demand for the Australian dollar, the first thing that could be done is domestic interest rates can be lowered. Now, the way that works is that this original increase in demand is likely to still exist if it's, say, an increase in commodity prices driving an increase in the demand for the Australian dollar. But with a reduction in domestic interest rates, that's going to move the demand curve back to the left. So in terms of this diagram, in terms of learning how this works, it's kind of easiest to say the demand curve shifts to the right, but then interest rates are lowered and it shifts to the left, back to the left. But in reality, that would cause a sudden movement in the exchange rate from 0.7 to 0.75 and then back down to 0.7. So domestic interest rates would actually be lowered to prevent the demand curve from ever moving away from its original position. Now this is a simplification, of course. So as this upward pressure on the Australian dollar is experienced in the market, we get a situation where domestic interest rates are lowered, and that lowering of domestic interest rates will actually cause less money or a smaller inflow of money from overseas into Australia, and that smaller inflow of money into Australia is what decreases the demand for the Australian dollar. The second thing that could be done is to keep the exchange rate at 0.7, the supply curve of the Australian dollar could actually be increased by a similar amount. So the supply curve could be shifted to the right so that it intersects the new demand curve at the dotted line at the fixed exchange rate of 0.7. So just imagine the supply curve moves out and creates a new equilibrium at 0.70. So how can the central bank actually increase the supply of the Australian dollar in the foreign exchange market? Well, central banks have reserves of their own currency, so domestic currency reserves. What the central bank could do, if it wanted to maintain this fixed exchange rate, is simply go into foreign exchange markets and supply more of its own currency into that market. But it's important you understand that the transaction that would be involved in that sort of process. The transaction would be the central bank would use its reserves of its own currency to buy foreign exchange. So by buying foreign exchange, the central bank is also not only creating a demand for that foreign exchange, whether it's US dollars, euros or yen, but they are also at the same time increasing the supply of the Australian dollar. So by buying foreign exchange, they are simultaneously, in the same transaction, increasing the supply of the Australian dollar. Now the final point in this slide is a very important one. This type of fixed exchange rate system really forces a central bank to give up monetary policy autonomy. What you can see, and what monetary policy autonomy means, or giving up monetary policy autonomy, means that the central bank is no longer able to use the tools of monetary policy to target the inflation rate and keep it between, say, 2 to 3%. Because in this example, what the central bank is doing is raising interest rates up and down and changing the supply of the Australian dollar in the foreign exchange market to manipulate the currency value and keep it at 0.7. Actually, one other thing that you need to realise, number 2 actually involves an increase in the supply of the Australian dollar, an increase in the money supply in the domestic economy, because when a central bank keeps the exchange rate fixed at 0.7 using number 2, they are injecting more Aussie dollars into the foreign exchange market, but those Aussie dollars quickly come back into the Australian economy because that increased supply of Australian dollars is being purchased by foreigners. Those foreigners use those extra Australian dollars that are being supplied in the forex market to buy Australian goods and services, and as soon as they buy Australian goods and services, that money is now in the Australian economy. So number 2 involves increasing the supply of money in the domestic economy. So one is moving interest rates up and down, involves moving interest rates up and down. Number 2 involves changing the domestic money supply effectively. These are both monetary policy type measures. And so what you can see here is that monetary policy is being used to keep the exchange rate at 0.7. Therefore, monetary policy cannot be used to keep inflation low or to target a low inflation rate. Now, with a fixed exchange rate system, such as Hong Kong, what I've got here is this graph from 1999 through to about 2015. You can see the value of the Hong Kong dollar. And so the Hong Kong dollar over this period was fixed, but it's not... what I'm trying to say is that there are minor fluctuations in the value of the Hong Kong dollar over this period. The fluctuations on the left-hand scale are not large, but there are some fluctuations. So even if an exchange rate is fixed, it doesn't mean that it is held perfectly against or to another currency at a certain value. There are minor fluctuations in even a fixed exchange rate system. It's just that they're very minor. So there's a couple of articles there for you to read about currency boards and Hong Kong's fixed exchange rate system. What I've tried to do in this diagram is explain to you in general terms how an exchange rate is actually fixed at a predetermined value, and now it's up to you to learn a little bit more about Hong Kong's fixed exchange rate system in the context of what we're doing. So in terms of fixed exchange rates, you need to understand what they are, how they operate, and the costs and the benefits of a fixed exchange rate system. So what I've got here is a bit of a summary in the case of Hong Kong. The example that we were looking at here was a fixed exchange rate system and money flowing into the country as an example of an increase in demand. So now let's consider the Hong Kong case. Over on the left here we've got capital inflow. So starting from the bottom, when money flows into Hong Kong, capital inflow, the people, the market participants who want to send that money into Hong Kong need to buy Hong Kong dollars to send their money into Hong Kong. That then puts upward pressure on the value of the Hong Kong dollar. So in terms of demand and supply analysis, the demand curve for the Hong Kong dollar shifts to the right. The currency board then sells Hong Kong dollars or supplies Hong Kong dollars into the market. In exchange, they accumulate more foreign exchange reserves. The currency board, that is. Now, when the currency board supplies or sells more Hong Kong dollars into the foreign exchange market, that money quickly comes back into the domestic Hong Kong economy, and that is what then increases the monetary base in Hong Kong. With more money in the system, it puts downward pressure on interest rates because there is just more money available, so interest rates fall, but through this process Hong Kong does achieve exchange rate stability. So there is quite a significant cost of actually operating this fixed exchange rate system, and that is loss of monetary policy autonomy. So let's go through an example to just emphasize the costs that are imposed on an economy when it runs a fixed exchange rate system, or the difficulties of running a fixed exchange rate system. Let's just imagine that this original capital inflow, that money is flowing into the Hong Kong economy because the Hong Kong economy is performing really well and people want to invest in Hong Kong shares and they want to take part in direct investments in Hong Kong. So what we've got is money flowing in because the Hong Kong economy is performing very, very well. There's a boom underway. Production growth is strong, employment growth is strong, GDP growth is strong. That's the scenario that I've created. Now, as that money is flowing in because of the very good macroeconomic performance in Hong Kong, to keep the exchange rate fixed, Hong Kong needs to actually decrease interest rates effectively by increasing the domestic monetary base. So Hong Kong now needs to lower domestic interest rates at a time when a boom is underway, which is exactly the time that you would be thinking interest rates should be rising, not falling. So this is a very difficult situation that Hong Kong faces itself with, so it needs to find some other way to actually slow down the level of economic activity. And so, of course, this is very difficult to do with a fixed exchange rate system. So that is just one example of the problems associated with a fixed exchange rate system. Now, you need to enhance your understanding of what we've been talking about here through your own reading. And there's certainly plenty to read that I've made available for reading in terms of fixed exchange rate systems in this topic. On the right hand side, we've just got capital outflow, which is the opposite of the capital inflow on the left hand side. Next thing we've got to do is look at the advantages and the disadvantages of floating exchange rate systems, but I'll do that in another recording.